This video will help you understand which accounts the IRS will and won't let you pool together for the purposes of satisfying required minimum distributions. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. As we approach our mid-70s, the IRS starts to levy what are called required minimum distributions, and these are the mandatory withdrawals you must make out of your pre-tax retirement accounts. They apply to all your pre-tax accounts, 401ks, IRAs, deferred compensation plans, etc. Essentially, you took a tax deduction on funding this account years ago, and the IRS is trying to collect some tax revenue before you die. And based on how much money you had in the account at the end of last year and how much longer the IRS expects you to live, that will result in a required minimum distribution amount. And if you don't meet the required minimum distribution amount, you don't distribute enough out of your account during the year, then you'll pay a 25% penalty tax on the amount of undistributed required minimum distribution. If you add that to your income tax rate, and let's say you're at a 24% tax rate on the federal level, that means that on money you don't take out of your retirement account, you'll probably pay somewhere in the ballpark of 49% in taxes on that. Now, 24% on the federal level is what you would have paid anyways, but that additional 25% fee can add up very quickly. And that's not even to consider all the state income tax ramifications that may apply to your particular state. Back in the day, the penalty was somewhere in the ballpark of 50% on undistributed required minimum distribution balances. That fee is now 25%. And you want to get this number right because if you take out too little, you'll pay that 25% tax. However, if you pull out too much, well, then you're irrevocably removing tax deferred money from a tax qualified retirement account, and that money will no longer be able to grow and compound tax deferred. So in general, you don't want to take out too much and you don't want to take out too little. Now, the IRS permits some accounts to be pooled together for the purposes of calculating that required minimum distribution. For example, all traditional IRA balances, whether you have one traditional IRA or 7, can be pooled together for the purposes of calculating how much you need to withdraw out of a traditional IRA or a combination of multiple. This is called account aggregation. And you might actually come into play with this rule if ever you looked into doing a backdoor Roth IRA, but you already had an existing traditional IRA on the balance sheet. As you might know, if you fund a backdoor Roth IRA, but you have existing pre-tax IRA money already on your balance sheet, when you go to do the Roth conversion, what you otherwise thought was a tax-free Roth conversion could very quickly result in some income taxes because all your IRAs are pooled together and you can't pick and choose which IRA you're going to Roth convert from. On the other hand, all of your employer-sponsored retirement plans, whether you're still employed there or not, are all considered separate accounts. So in the event you tried to pool all of your old 401ks together and satisfy whatever dollar amount in required minimum distribution you had to distribute, you'd have to actually do the calculation for every single different retirement plan and then distribute the money out of each plan accordingly. Now, among other pros and cons, that's one of the reasons why you generally see people try to consolidate all of their retirement plans once they enter into retirement, and ideally well beforehand, because any missing retirement accounts you're not tracking on the balance sheet will have a required minimum distribution, and you could definitely face some tax penalties if you forget to take out that company's respective required minimum distribution. Now, one quick note on which accounts can or cannot be aggregated together are IRAs and their different forms. So as you might know, there's different types of traditional IRAs. There's SEP IRAs, there's simple IRAs, and way back in the day they had SAR-SEP IRAs that are pretty much going the way of the buffalo. But all of those IRAs are still considered traditional IRAs, and all of them can be account aggregated. Now, of course, you're always at liberty to do individual required minimum distribution calculations from each account if you want to, but that's kind of an exercise in futility because you're going to get the exact same number, which is $1 value that must be distributed from traditional IRAs. Now, most of the time, I've only ever done this for clients when it makes sense because maybe in one IRA, they own some illiquid money and maybe that IRA is held at a different institution for certain reasons. And so we'll take all the required minimum distribution money out of a more liquid IRA. But generally, there's not a huge value in having multiple of the exact same tax types of accounts. I guess that brings up another point. It doesn't matter if all of your traditional IRAs are at a bunch of different financial institutions, you can still aggregate them together. Yes, is it more work than if you just had one big IRA at one particular financial company? Totally. But maybe there's reasons you're doing that, but just know that you can satisfy the annual required minimum distribution of all your IRAs by taking out just one big RMD from one of your multiple IRAs. Now, you might hear that if you're still working at a company, you may or may not be hit with required minimum distributions. So let's jump into clarification on that. So if the money is held in a traditional IRA, whether you're still working or not, if you're in your mid-70s, you will have a required minimum distribution from that IRA. However, if you have money at a current 401k with an employer that you're still employed at, if you satisfy these rules from the IRS, then you do not have to take out a required minimum distribution from that 401k. And those rules are pretty simple. You still work for this company, and you're not more than a 5% owner of said company. So if you're self-employed and it's your own solo 401k, no, you don't get to delay required minimum distributions for the rest of your life. But if, let's say, you're a W-2 salaried employee somewhere of a very large institution, then you do not have to take out required minimum distributions if you're still working at that company and you're well past your mid-70s. Now, that doesn't absolve you from needing to take out required minimum distributions from old 401ks or old 403bs or your current traditional IRA. And so there might be a strategy there where you could look into consolidating things into your existing company's 401k. Because just like doing a backdoor Roth IRA, if you don't have a traditional IRA on the balance sheet, then the IRS doesn't have any other IRAs to aggregate together. And in this case, if everything just got rolled into your current employer's 401k and you don't have an IRA on the balance sheet, then theoretically you would not have a required minimum distribution that year. Now, of course, you could also look into doing traditional IRA to Roth IRA conversions or traditional 401k to Roth 401k conversions, because Roth accounts do not have required minimum distributions. Now, once you enter into the year, you can already do your required minimum distribution for the whole year, and that money has to come out of the account. You can't do a Roth conversion on December 1st to avoid needing to take out money from a pre-tax retirement plan by December 31st. Once the year starts, you've got to take that money out. But for future years, you could definitely avoid taking out required minimum distributions by doing Roth conversions ahead of time. Now, a Roth conversion will result in you paying income taxes on the amount of money that you Roth convert, but maybe there's a tax dynamic at play whereby paying taxes today on the Roth converted amount still grows and compounds tax deferred, but maybe in future years, if maybe you're going to be in a higher income tax bracket or you forecast tax brackets going up, then when you take that money out in the future, if at all, then that money distributed will be at a lower tax rate than today. Of course, if you assume you're going to be at a very high tax rate for the rest of your life, it could still make sense to do some Roth conversions so that the next generation can inherit the Roth money completely tax-free. And yes, they'll have a required minimum distribution when they inherit the money, because inherited Roth accounts do have required minimum distributions, but they won't have any income taxes as a result of pulling out those distributions. So as kind of an estate planning play, Generation 1 might choose to pay the income taxes on the money they Roth convert, so that Generation 2 doesn't have to pay those income taxes. Now, that's purely a benevolent move. It does not at all help somebody with their own retirement plan just to pay income taxes just for the sake of it, but it could make some sense for your situation, and of course it would help you avoid paying future required minimum distributions. So from a calls to action standpoint, I would say if you're approaching your mid-70s or you're already in RMD years, I would definitely look at seeing if there's a benefit at play. Of course, if you're still working, maybe look to consolidate things into the current company 401k and avoid future year required minimum distributions, or at least kind of defer them. Or of course, if you have multiple different retirement plans, it could make some sense to look into doing consolidation, especially if you're not working anymore. I don't really know what the huge benefit would be in having multiple different types of accounts of the same tax type, especially if they're employer-sponsored plans, because that's a lot of math and liability that you assume when probably in your 70s, life would be a lot easier if you just had one account to deal with. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.